Good morning. I'm tracking a critical inflection point in the Charlotte market right now. The Queen City's commercial real estate landscape is being reshaped by three converging forces: persistent inflation pressure, a stabilizing labor market, and mortgage rates holding at levels that are fundamentally altering investment calculus. Over the next 5 minutes, we'll break down what these forces mean for your portfolio. Let's begin. Charlotte's commercial real estate ecosystem is operating within a macroeconomic environment that demands precision and discipline. The Federal Reserve's funds rate sits at 5.33%. That's an estimate, but it reflects the central bank's commitment to tempering inflation without overdoing the medicine. Speaking of inflation, year-over-year CPI stands at 3.4%. Still elevated, but trending toward normalization. The unemployment rate is holding at 3.7%, another estimate that underscores a resilient labor market. These conditions create a stable, if not exuberant, backdrop for commercial activity. Let's drill into the metrics that matter most for Charlotte investors right now. Housing starts for the region are running at 1,380 units. That's an estimate, but it's directionally important because residential construction velocity often signals confidence in the broader real estate cycle. When builders are actively breaking ground, it typically reflects their confidence in long-term demand. But here's what you need to hear: that number is being pulled down by the cost of capital. Every 50 basis points of rate increase effectively removes a meaningful segment of buyers from the pool. Three trends are shaping decision-making in Charlotte right now, and understanding them is essential. First, cap rate normalization. We've moved past the era of yield chasing at any cost. Buyers today are discriminating between assets with real operational upside and those that are simply banking on refinancing magic. That's a healthy recalibration. Second, the bifurcation between prime and secondary assets is widening. Core assets in prime locations continue to attract capital from institutions and 1031 exchanges. Secondary locations are facing a genuine reset. Landlords accustomed to rent growth at inflation-plus rates are recognizing that tenant demand is more fragile than they assumed. Here's the takeaway: Charlotte remains a market worth your attention. It has the demographic pull, the corporate base, and the amenity profile that supports durable commercial real estate values. But it's not immune to the cost of capital reality that's reshaping the industry. The investors who will succeed over the next 18 months are those who acknowledge that higher rates are not temporary and that repricing, while painful for some, is opening opportunities for disciplined capital. At RipplEffekt, we're tracking every major asset class across the Charlotte metro. Visit us at RipplEffekt.com for the full intelligence brief.